Welcome to Maze Dive Sunday, podcast segment where we're going to a deep dive into a single stock, one company, one story, so you can stop guessing and start investing smarter. No fluff, no jargon salad, just real talk from one retail investor to another. I'm your host Jay, and today we're diving into Pick n Pay, the South African retail legend that just posted a 736 million net loss. Yes, it's a loss, but somehow everyone's smiling. So let's unpack what's going on, what the numbers say, and what you should do if you're holding, buying, or just trauma watching from the sidelines. So let's hit with the headline numbers straight from the start. Net loss, 736 million. Last year's loss, 3.2 billion. Loss before tax and capital items is 236 million versus the 1.4 billion previously. That's a massive improvement. Still a loss, but we've moved from financial ICU to rehab with physio twice a week. Now, what's working and what's not? Well, Boxer's carrying the brand. It's the golden child now. Sales are up 13.2%, turnover 42 billion, and a market cap sitting at about 30 billion rand. Pick n Pay's own market cap, 21 billion. So Boxer's the kid who skipped university, opened a butchery, and is now paying your DSTV. Core Pick n Pay stores is better but still limping. Pick n Pay's legacy stores posted a 549 million rand trading loss, down from 1.5 billion. They even turned a profit in the second half of the year, so someone's been attending their financial AA meetings. Group turnover up 5.6% to 118.6 billion, but most of that came from Boxer. Pick n Pay's own brand sales barely crept up 1.9%. Boxer brought up the grid, the meat and the firelighters to this braai. Pick n Pay brought a half pack of stale rolls and forgot the cooler box. Debt and interest, well, that's manageable. They've cut the interest bill by 27.3% thanks to Boxer's IPO and recap funding. Still not debt-free, but they've stopped hiding from the repo man. So let's do a reality check. Don't let the headline improvement blind you. The core business is still on a tightrope. Margins are very tight, competition's brutal. ShopRite, Checkers and Woolies are dancing while Pick n Pay still trying to tie its laces. The new break-even target is 2028, a year later than planned, and yes, they closed and converted 40 stores this year to stop this bleeding from happening. One wrong move, a Boxer slowdown, or another strategic brain fart, and this turnaround tale goes from hopeful to horror. Let's wrap this up with my signature Stokvel starter pack, stock unpacking tail edition. Net loss, 736 million, which is better than the 3.2 billion last year. Boxer sales growth, 13.2%. Group turnovers, 118.6 billion, that's an increase of 5.6%. Core trading loss is 549 million, but improving. Break-even goal is 2028. The interest bill is down 27.3%, and the market cap battle, Boxer being 30 billion versus Pick n Pay's 21 billion. This one's a masterclass in less pain, still counts as progress. So, what shall we do? Do we hold, buy, or watch? In this case, Boxer's strong, but Pick n Pay needs to prove that it needs to be in my portfolio, so I'll call this a watchlist stock with snack privileges. And that's your Maze Dive Sunday. If you learned something today, or if this episode made you side-eye your grocery receipt, hit follow on Spotify, subscribe wherever you get your podcasts, and share it with someone who thinks Pick n Pay is still the best thing available. Catch me on X, and don't miss Tuesday's episode where we decode some more of the stock market jargon and other financial terms analysts love to flex with. For the serious bit, just a reminder, I'm not a financial advisor. This isn't financial advice. It's educational, a little entertaining, and full of opinionated analysis from a fellow investor. Please do your own research and chat to someone licensed before putting your money anywhere. Until next time, this is Jay, and I'll catch you on Tuesday.